All right, so in chapter 2, we're going to be looking at the balance sheet, but we're also going to go back and look at some transactions. We will also look at journal entries and how your information gets into a journal and a ledger and eventually into that balance sheet. And then we're also going to look at, I believe it's the classified balance sheet. All right, so to get started, again, so notice again your balance sheet. If you build it, it's, to keep it simple, it's really just your accounting equation, if you recall that. So notice you've got your assets. Let me get my arrow on. You get your assets, again, which is your benefits to the company, your ownership. You've got liabilities, and of course the owner's claims to the business, which is your equity. So your balance sheet is really just your detailed accounting equation. And of course, and again, we'll get into a lot of these things as we proceed in the semester, but of course, liabilities, they often refer to that as debt financing, where you're borrowing money. Whereas when we get to the equity part of it, where we sell stock, they call that equity finances. And a lot of companies have a balance between how much debt they want and how much equity. There's always cost and benefits to both of these. All right, so that's what they're talking about in that one. All right, and again, so you invest in assets, of course, and again, your liabilities are debt, and your stockholders' equity, think of that as your equity financing. Okay, so let me get to, all right, what I want to get to is I want to show you that, of course, when we're building this balance sheet, is we're going to have to look at some transactions in terms of what types of different accounts are affected on the balance sheet. But again, in our end, we have to have documentation. We have to know that, of course, everything is based on some sort of financial concept. So notice everything is going to be stated in some sort of, currency. All right, so we're going to look at some different transactions in terms of how they affect each of these items, whether it's assets, liabilities, or equity. And then, of course, we could have external events as well as internal events, specifically when we get to adjusting entries later on in the semester. All right, so of course, to start off, you'd have you have to analyze the transaction, and then of course you're going to then record it, and that's what we're going to get into a little bit in this chapter, and then to summarize it again when we get to those the balance sheet in terms of the financial equation. Remember the duality effect. There's always at least two items affected because you have to balance. And in some cases, I believe you're going to find that you have a lot more than just two items that are affected. All right, so here we've got different types of accounts, and you'll notice, they often put account numbers next to these names. That's usually for the recording aspect of using technology. Usually assets start with the number 1. Liabilities usually start with the number 2, and then of course your equity has number 3. And these are just small codes. Usually in industry, these numbers can get a lot longer, but these are your basic types of names that you might have in a typical business. All right, so just some basic analysis of your accounting equation. Of course, if we've got, notice we've got the company issues common stock. As evidence of the contribution, they get $10,000 cash, which is deposited into the company's bank account. So of course, we're going to increase our assets by 10,000, and then that's going to be that category. We're going to call it common stock. That's going to go under equity. Notice you are balanced as you go. Notice in the next one, they buy a trademark, which is another type of, it's what they call an intangible asset. But notice it's going to cost us $300, and then we're going to put it into a trademark category. These are both assets. So also notice that the only category affected on the accounting equation is just your assets. It's a plus or minus 300. So that again is why you are still balanced. Here's an example where they're borrowing money, taking a loan out from a bank. So you got the cash, but then here's that, no, it's a liability. So you increase the cash and you increase your liability. The next one says you're going to buy some equipment on account. In this case, you're simply going to increase your equipment account by $9,600. And again, most likely under accounts payable because you're going to pay the money back at the end of the month. So usually that's a short-term deal. Usually those go under what's called accounts payable and not notes payable. If it's notes payable, usually you might have some interest involved because it's long-term. So here's an example of just when you're paying your bills, you're paying your debt. So you notice you are going to be decreasing your accounts payable and decreasing your cash by the same amount. And notice here, it says they signed a contract. In this case, there's actually no effect. If you notice, and they like to trick you on these, but they sign a contract with the programmer. The code has not yet been received. So this is just like the initial agreement, like signing of a contract, but it's more about future delivery. Nothing's actually happened just yet. So in this case, there would actually be no change to the accounting equation. And here's a case where they actually, bought some software, but they didn't pay it all in cash. So you notice that the software cost $9,000, they paid $4,000 in cash, and the rest they owe as a liability. So if you net the two, 9 minus 4 is 5, and that equals 5. So your equation is still balanced. All right, next one looks like you bought some supplies on account. And again, a lot of these you've seen from your applied accounting, but again, you'd increase supplies and increase accounts payable. And again, this is just kind of one way of showing how the accounting equation would summarize all this. Here's your top categories. You'll notice here's your equation. And notice at the end, you add up each column of each of these. And of course, you would be balanced. And then eventually, you can then get to your financial statements. All right, so T accounts. T accounts usually is when you start to learn about your debits and credits, which you guys mostly should know at this point. But notice you've got assets, you've got the debit and credit side is universal for all these. And let me draw something out here on this slide just to kind of give you my version of a little bit better visual. So if I am looking at an asset T account, I like to use pluses and minuses. So if I've got my assets, I would say plus, minus. So if we got debit on the left and credit on the right, you say assets increase with debits and decrease with credits. Your liabilities, let me draw my T account, that's going to be just the opposite. So it's going to be minus plus. So your liabilities will increase on the credit side, just like for stockholders' equity, same thing. Again, you've got your debit and your credit. It's again minus plus. And again, the normal balance is wherever you see that plus sign. So that's when they're saying normal balance. Notice your normal balance is always going to be on the increase side of that particular cost category. Or sorry, I should say account category would be a better term for that. All right. So, so you get the T account idea, and then of course here's what your journal entries will look like. So notice in accounting they always write their debits first, and then they indent with their credits. Notice debits don't equal credits. So here would be an example of your journal, which again should look familiar to you from again your applied accounting. So more journal entries, and then here's the ledger. Notice your journal gets posted to your ledger. Your ledger is your summary. So for software, if you got $9,000 debit here, notice that's going to show up in your ledger account as well. If that's cash of a credit of 4, that credit of 4 should also be showing up somewhere in the cash ledger, which is right there. I quite often, when I teach this in person, because the ledger is really just a concept. Ledgers can look very different depending on where you go, but I like to use the T account as saying, if you understand the T account, just use that idea as your general ledger. And as you can see, they're trying to draw, looks like a red T account right there, just to kind of show you here's your debit and credit. But then they also have another column that's also updating your balance. Okay, all right. And then of course, like I just said, you summarize, your ledger summarizes your journal. Okay. So again, here's just kind of more of the same, just kind of went through these, but in this case, they're showing you the analysis part of it. I'm not going to go through every one of these, but your analysis is a part of it, of how it will affect your accounting equation. This is how your journal entry will record it, and this is how your general ledger would summarize it. So your accounting equation is kind of, you're classifying it, you're saying where does it go, what increases, decrease, This is your journal entry debit and credit, and then this is your summary in your ledger. And as you can see, as you go through these, as we just looked at them earlier, it's the same idea. You got your accounting equation, journal entry, and then your ledger. And again, I'm not going to go through every one of these. You can read through these. They're pretty consistent, but these are the ones that we talked about earlier. Okay, and then here's just a final summary of that. Notice here is all of your journal entries. Notice there's a letter assigned just so you can track it to what account it's going to. So if you go to any T account ledger, notice this 10,000, you should be able to trace that back to your journal entry debit right there. But so here's your journal summary, and then here's your ledger summary. All right, now we get to the balance sheet again. So again, here's your trial balance. Now remember, your trial balance debits always equal your credits. And then here's the concept of the classified balance sheet, which I know in my applied accounting class, I get into this at the end of the semester, but we talk about this concept of a current asset or a current liability. And typically those are items that are either paid or used within 1 year, or they like to say 12 months. So notice your current assets typically are cash and supplies that's usually either converted to cash or used within a year. Everything else is typically more than a year. So notice equipment, software, logo, those are lasting more than a year. So that they are put in a different category outside of current. Same thing with your current liabilities, accounts payable, short term, that's due soon. Everything else is long term. And then of course you've got your equity that doesn't change. Common stock and retained earnings are your two components of equity. All right, you can look at ratios to do some of your analysis, and that's why you group these into your current settings. You'll notice the current ratio, which is your current assets divided by your current liabilities. You're basically seeing how much you can cover your current debt with your current assets. In this case, you're covering it by 2.09 times. And then I think one thing, I think that's all my comments, I think. Oh, a couple things. Yeah, this I guess kind of important. Amounts are assigned. Typically, everything on here is usually recorded initially at cost, not market value. So supplies, this number is what you paid for the supplies. The equipment, that's what you paid for the equipment. Now, eventually we'll get into the accumulated depreciation and so forth, but usually what they call the historical cost principle, usually everything's recorded initially what you pay for it. So that is kind of an important thing you should know. All right, the rest is in the supplements. And then we've already talked a little about the accounting careers, and you can kind of read through that, but typically you can go through public accounting or private accounting, or even governmental accounting typically, and you can look at the different types of skill sets. But there's a lot of demand for the accounting career student. It's still a really good field to go into. You can see how they like to throw in some of the money. Usually the type of money you're going to be making, you're not going to be making $200,000 at the start. Usually these are people who have 10, 15, 20 years experience into the business, but eventually it's definitely a good career that you can grow and make some pretty good money in as well. All right, so I think the rest in chapter 2 is just some illustrations, since I'll walk you through some of these transactions. And we're just going to go through the different types of journal entries. With some of these you've seen before. On this particular one, you'll note we've got 3 transactions. The first one is this: if you sell stock. So you debit cash and you credit common stock. That's just showing you that entry. Another one is saying where you bought some land. Notice is what you paid for it. Notice wherever it's estimated doesn't matter. It's what you pay is what gets recorded. So notice they debit land for 60, credit cash for 60. And then of course the last one, you bought some supplies. You paid $9,000 for supplies on account. You're just debiting supplies, crediting accounts payable. Again, most of this should be reviewed from your applied accounting. Another example where you are borrowing money. So notice they're debiting cash, and notice if it's long term, it goes to notes payable, not accounts payable. And of course, this one says one of the owners sold 10,000 worth of stock to another shareholder. That's a third party arrangement. That none of that money goes to the company. That's just being exchanged between owners. So in this case, there's no transaction. Again, some more types of exercises. And again, I'm just kind of jumping through and just commenting on the actual results. On this one, on part A, looks like they're buying some equipment, debiting equipment, crediting cash. And then on part B, it looks like they're buying inventory, again, on account for $7,000. Some more examples. Borrowing money again. This one's a short term. Still, you debit cash, credit notes payable. Part D, it looks like you're paying on account, so debit AP, credit cash. And then on part E, you're paying some of your loan by debiting notes payable and crediting cash. Notice they're not really getting into the interest just yet. Eventually, we'll get into how you calculate that interest payment as well. And again, note some more illustrations. Again, equipment, accounts payable, buying equipment on account. Notice there's your asset liability. Notice how you're paying on account on part B, debit AP, credit cash. And then on C, you're collecting from your accounts receivable. So debit cash, credit accounts receivable. And then keep in mind, they're also illustrating what item would be affected again on your balance sheet. Again, here's some more selling stock, always debit cash, credit stock. And then of course, here's an example where you didn't buy all of your equipment all at once. You had to pay some on a loan. So you credit cash for what you paid, and the difference is what you're going to pay off. They're going to put that into the notes payable. Okay. And again, the rest of these, I'll just, again, some brief comments because I know you know these, but here's just a collection of an accounts receivable. Here's just you hired somebody, but they haven't done anything yet. So that's just no transaction. And then on part C, you're just paying off part of your debt by debiting AP and crediting cash. And then looks like we've got, again, paying a note payable, and then some of the same transactions. You can kind of review these, but hopefully you're starting to see, there's a lot of repetition. But again, I'm not going to comment on every single one. Again, here's the last one they give us is they give us 5 transactions, and they show you at the bottom here. They want you to go through these and say, how would these affect your accounting equation? And of course, they're showing you the increases or the decreases in the assets or the liabilities. And then in the end, they're going to show you what that equity. The only equity item here is the common stock of 10. They kept it simple. And then I believe in the last one, again, this is just recording in your basic journal entries. So you notice you've got a common stock sale of cash, debit cash, credit common stock. You borrowed money from a bank, debit cash, credit notes payable. Notice they're identifying the account of where we're going to balance sheet. And then part C, it looks like you bought some more equipment on account. And then I think in the last slide we'll get to is we bought some land, but we didn't pay it all. This is again letter D. So the note, there's your $11,000 that you still owe. This is what you paid in cash. And then notice on E, the same type of deal, except they put it in accounts payable. Again, anytime you have 3 accounts affected, if you recall, they call those compound entries. All right, I believe that's the last comments for my chapter 2. Again, you'll notice there's a lot of review in chapter 2. I think just about everything on here except for the common stock you probably have seen in applied accounting. All right, so next up will be some of the textbook, and then of course you'll be working on your Connect homework problems.